the audit. That letter, you have 90 days when you get this letter, right? It's called an NOD, Notice of Deficiency. And you have 90 days from when you get this letter after the audit to file in tax court. If you miss the deadline by a day, you're hosed. We take cases on contingency. I just had a case up in Massachusetts where a lady did one flip, and the IRS said it was not a trade or business, so she couldn't write a lot of things off. But the mistake the auditor made is he confused a trade or business with being a dealer. And he said she had to be a dealer, buy and sell a ton of properties to write things off. That's just wrong. We couldn't talk sense into him, so we quickly ended the audit. We pretty much told him, you know what, write a report that says my client owes $1 billion. We don't really care what number it is because it's not going to stand. And then we sued in tax court. Within 2 months, we got a settlement, which is what normally happens in tax court. We dropped her tax from $24,000 to $6,000. Now that's one that I took on contingency, so I got a cut of the action. She did not want to invest money up front. She would have been better off paying me by the hour. It would have been cheaper, but she didn't know that up front, so she decided that she didn't want to take the risk. Bottom line is, tax court is a big option that a lot of people miss. So if you ever get audited, or you know someone who's been audited, and the audit goes badly, get a hold of me or someone like me, but do it quickly, right after the audit, so that we don't miss the deadlines. I do a lot of that sort of work as well. So research, planning, fighting the IRS, and once you owe them money, you also get into dropping the amount of money they'll take or working out a payment plan. So pretty experienced. I've been doing this 23 years, and I do have my own real estate. Like I said, mostly low-income rentals. We're selling a lot of it because I want to be in cash. I think we're due at some point here in the fairly near future for things hitting the skids. We still buy, but we're a lot pickier about what we'll buy. And I'm getting more into buying low-income properties, and instead of renting them, selling them on land contract, either to investors or once in a while to residents, especially first-generation Hispanics. So there's some idea of what I do. Now, the focus today is to talk about self-directed tax accounts. So we're going to talk about self-directed IRAs, 401ks, health savings accounts, and Coverdale educational savings accounts. And a lot of people forget 3 out of the 4. They think self-directed IRAs, they forget about 401ks, which are actually much better accounts and much more powerful, especially if you qualify for a solo 401k. But they also forget about health savings accounts that work like self-directed Roth IRAs. They're very similar. The rules are almost identical. Obviously, instead of funding your retirement, you use a health savings account to fund medical, but medical is very broad. I funded a trip overseas for healthcare. I went to my wife's country. My wife is from Chile, and I got some sinus surgery done that my insurance wouldn't pay. And I got it done at about 20% of the US cost. And I paid that out of the health savings account. People also forget about Coverdale educational savings accounts. Those work like Roth IRAs. The challenge with them is you can only put a little bit of money in them, $2,000 a year, but there are ways to grow that amount. There are creative, legitimate ways to grow that amount. There are also a lot of illegitimate ways that people suggest, especially on the internet, of how to grow those accounts. But Coverdale educational savings accounts will pay for 3 things. K through 12 private education, that's K through 12 private education, university, college, and also home computer use, right? If you've got a student in the house, the whole family's allowed to use the home computer. The Coverdale can pay for not just the computer, but the printer, the ink, the tutoring, the internet, the paper in the printer, etc. It's pretty broad what you can use those for. So I want you to remember that when I say IRA, I really mean IRAs, 401ks, health savings accounts, and Coverdale educational savings accounts. The rules are very similar between all 4. Who does this work for in terms of the IRAs? As we kind of intimated at the beginning of the call, there are really 2 classes of people that really, if they're not investing through self-directed accounts, they're crazy. If you are making enough money that some or all of your real estate, you just don't need the money from it. That's my situation, right? I have a law practice. We're doing well. And I live on about 20% of the income from my law practice. Everything else gets invested. So if I buy a property, if I make a profit from selling it, if I rent it, all that money is just going to go into more real estate. So why pay tax? Why not run the property through one of these accounts? Avoid tax. Because what's the biggest objection people have to self-directed IRAs and these other accounts? Well, I can't get the money out until I'm 60. Well, if you weren't going to use the money and touch it anyway, and you were just going to reinvest it, these accounts are perfect. You're crazy for not using them. I think the other category of person who's crazy for not using these accounts is if you're 59 and a half. That's the age where you can start taking money out. Now, to make it easier, I'm just going to say 60. So I'm going to round up a little. If you're 60 or older and doing deals, whether you're buying and selling, whether you're renting, whether you're investing in debt or making loans, if you're not running that through one of these accounts, especially a Roth account, you're crazy. You're missing out. You're paying way more tax than you have to, because an IRA is essentially just another entity, right? Like an LLC or a corporation. It's just another entity, and it's got its own set of rules. Now, the rules are complicated, but the amount of money you save is worth learning it. So if you're investing in real estate and you don't need the money, or at least you don't need all the money, or if you're 59 and a half, let's say 60 or older, and you're not using these accounts, you're missing out, especially on the Roth accounts. One of the taglines for today's webinar was how I saved a client $100,000. And I picked that modest number. We actually, if we use these accounts, save clients way more money. There's a spreadsheet I show when I present at RIAs. If you do one flip a year, by flip, let me define that. By one flip a year, I mean you buy, take title, rehab, and sell. So you buy, take title, rehab, and sell. If you compare doing one flip a year in a Roth IRA or a Roth 401k versus paying tax at 35%, if you start with a $100,000 flip, you make a 30% return on each one, and you compare paying 35% tax to a Roth, which is no tax. At the end of 10 years, if you pay tax, you have $600,000. If you don't pay tax, you have 1.4 million. That's the power of these accounts. If you keep investing that money for another 10 years at 12%, so you invest for 10 more years, total of 20 years, at 12%, you stop flipping and you just do rentals or hard money loans or whatnot. At the end of 20 years, one account, the taxable one, will have about 1.4 million. The non-taxable one will have over 4 million. And that's all from investing in the right kind of account. It's due solely to non-tax versus taxable compounding. So I want to demonstrate the power of these accounts. That's a huge amount of money. It matters. It's worth figuring these out. So let me give you a story how we saved one client. We actually saved him a lot more than 100,000, but I didn't want to make the number too big or it wouldn't sound believable on the tagline. I got a guy who does about 100 buy, rehab, and sell deals a year. He's actually in South Georgia and Northern Florida, so he's not too far from you guys. He does 100 buy, rehab, and sell deals a year. He makes about 20 grand on each, so about 2 million a year. He's now running half of those deals through a C corporation owned by a Roth 401k. Let me repeat that. He's now running about half those deals, about $1 million a year, through a Roth 401k that owns a C corporation. So let's walk through the math. We agree he's in the top bracket. If he ran these deals through his normal company, an S corporation, he would be taxed at the highest federal rate. That's 37%. Instead of that, we run it through a C corporation, which thanks to the new tax law, thank you, Donald Trump, right? Great new tax law for investors, 21% rate in C corporations. So he's paying a 21% rate instead of 37% on about $1 million. That's 160 in savings right there, right? 37% minus 21%, 16% on $1 million, 160 in savings. And the C corporation dumps money not into his hands, but into a Roth 401k. That $1 million that's dumping, or I guess $1 million minus 160 in taxes, so about 840 grand a year is dumping from the C Corp into the Roth 401k that owns 100% of the C Corp. How much will that be taxed at in the future? 0 for his lifetime and 0 for the lifetime of whomever inherits. Think about that. We're saving him way more than 160 grand a year. He easily somehow manages to live on the first million, and pays his normal tax. The other $1 million is now running through a C corporation owned by a Roth 401k. We cut the amount of tax paid, and future reinvestment will be completely tax-free. And here's the only real catch. What's the catch? He's not allowed to work for the corporation. Now, given how many flips he does, he has staff. He has a ton of people that work for him. They run the company, not him. So that's the key. He doesn't work for the company. We're saving him minimum 160 grand a year. And once you throw in the value of reinvesting the money into, say, rentals or hard money lending, and him not paying tax on it, we're saving him a crazy amount of money. So as you can tell, I really like Roth IRAs and Roth 401ks. Now, you may have an accountant who tells you, you make too much, you can't have a Roth IRA. And they probably don't even know Roth 401ks exist. But either way, you don't make too much. There's no income limit on the ability to contribute. It's that if you have too much income, you have to contribute indirectly. If you Google, I won't take time to explain it because it's all over the internet. If you Google backdoor Roth IRA, you'll see what I'm talking about, that you can get around the income limitation on direct contributions to a Roth IRA. So what are some of the tools we're giving you? Tax-free growth is hugely powerful. I prefer 401ks. In this case, it's not a coincidence that this gentleman is running about $1 million of flips in a C Corp owned by what? A Roth 401k. Why do I love Roth 401ks? Because I mentioned I would discuss this. That was tagline number 2. Why do we love 401ks over IRAs? First of all, understand you can contribute to both. It's not mutually exclusive. You can put money into a Roth IRA. You can put money into a Roth 401k. But let's talk about why do I love Roth 401ks the most? 5 reasons. 1, prohibited transactions do not destroy 401ks. Let me give you some background. A prohibited transaction, if you do this, it's a complicated subject. If we have time, we'll touch on it. But if you commit what's called a prohibited transaction, think big P and big T, inside of an IRA, Roth or traditional, or in an HSA, or in a Coverdale, also known as a CISA, Coverdale Educational Savings Account. A prohibited transaction destroys the account. Let me give you an example. You have $1 million in a Roth IRA. You lend your mother $1. Now, your IRA doing business with ancestors, descendants, and their spouses, or your spouse. So once again, your IRA doing business with ancestors, descendants, and their spouses, or your spouse, is one example of a prohibited transaction. And there's way more. That's just one basic example. So your IRA lends $1 to your mother, who's an ancestor. What happens? You have $1 million in the IRA. The IRA dies. The $1 million gets distributed. You pay about $500,000 in taxes and penalties and interest. You've got $500,000 left over, but it's no longer tax sheltered. So prohibited transactions are a disaster. This is not an area of tax law where you want to be aggressive. Now, I'm normally aggressive. Normally, if the law is gray, I'm going to use it in your favor. If the IRS says this is the law, but we have a better interpretation, and by better, I mean you pay less, that's the interpretation we're going to run with. But there are some areas of the tax law where we don't want to be aggressive, and prohibited transactions are one of them. Why don't we want to be aggressive? Because if you're wrong, the consequence is vast, except if what? You have a 401k. 401ks, when you commit a prohibited transaction, don't die. They pay a 15% penalty on the transaction per year, which we don't like that, but it is not necessarily horrible. Your 401k lends your mother $1. You pay 15 cents a year until the loan is paid back. That's a lot better than $500,000. That's the reason I love 401ks. That's the number one reason. They have more protection from prohibited transactions than any other type of account. Reason number 2, I love 401ks. Most people know that IRAs and 401ks and HSAs and CISAs can borrow. Your account can borrow. So one way to take a small account and make it into a very large account, let's say you only have a few $1,000s in there, is to borrow. but there's a price to borrowing. There's a tax called UBIT. UBIT stands for unrelated business income tax. Let's think of it as IRA tax. There are three things that if you do these in any of these accounts, you pay UBIT. And UBIT is a high tax. It's 37% plus whatever the state imposes. So you'd say, wait a minute, I thought IRAs were tax-free. What the heck? Well, they're tax-free, except when they're not. And the three cases where these four types of accounts, 401ks, IRAs, CESAs, and HSAs, are UBIT taxable are as follows. One, when one of these accounts rents out personal property. If it rents out personal property, and I mean personal versus real, so we're talking lawnmowers, furniture, automobiles, meth labs, all of that's personal property. So if the IRA rents it out, it pays a very high tax on the net rental income. Second, if you run a continuous trader business through an IRA, it pays UBIT. My buddy's flipping example, he flips about, good Lord, 50 deals a year through his IRA's C corporation per year. 50 deals a year of buying and selling is over the top continuous trader business. There's no question. It's black and white. Now, if you buy or sell one, maybe two properties a year in your IRA, is that a continuous trader business? Probably not. Probably not. So if you do one or two flips, and by flips, I mean you take title, not this assignment stuff. If we have time, I'll talk about why you don't do assignments in these accounts. I'm very against assignments or options that mimic assignments in these accounts. I think it's a huge legal mistake to do that in your IRA or your 401k or any of the other accounts. But if you actually take title, the IRA takes title to the property. Can an IRA buy, rehab, and sell one, maybe two properties a year? Yeah, I think so, without paying UBIT. But once you get a pattern, kind of like the dealer issue, once you get a pattern of being a dealer inside of your IRA or 401k, you pay UBIT. Likewise, if you buy a Dairy Queen, you buy a law practice, you buy a factory, all of that's an ongoing continuous trader business. If you buy that in an IRA, you're going to pay UBIT unless what? What's the example I started with? Unless what? You run the business through a C corporation. So if you're going to have a trader business in an IRA, a continuous trader business, own it through a C corporation. We call them blockers because they block UBIT. That's why my friend, instead of paying 37% UBIT on his flipping business, is only paying 21%. We got a blocker corporation in the mix. What's the third thing that causes UBIT? Borrowing. When an IRA or 401k borrows, you pay this UBIT tax, but it's proportional to the borrowing. Well, what does that mean? Let me give you an example. Your IRA buys a property for $100,000. It puts $10,000 down. It borrows $90,000. I think we would agree it's 90% leveraged. $90,000 of the $100,000 is financed through debt. That means that 90% of the income from the asset you bought pays UBIT. 90% of the net rental income after all deductions, 90% of the gain if you sell it would be subject to UBIT. Why did I mention all this? A, it's good stuff to know. B, 401ks don't pay UBIT when you borrow to acquire real estate. That's important for you guys being real estate investors. If a 401k borrows and let's say buys a rental property, no UBIT. If an IRA borrows to buy a rental property, it pays UBIT. So that's why I like running my leverage rental properties through a 401k. I avoid UBIT. The other benefits of a 401k, I mentioned prohibited transaction protection. You don't pay UBIT from borrowing. 3, you have automatic checkbook control, which is maybe good or maybe bad. We'll talk about that in a second. If you have a 401k, you can be the custodian. You don't need a separate custodian that you have to say, Mother, may I, every time you write a check. You can have that ability. But what's the real issue? Should you have that ability? You better know what you're good at, and you better know what you're not good at. So if you're good at paperwork and organization and detail orientation, it's okay to be the trustee or the custodian of your 401k. But if you're one of these people that you're really good at making deals, but you couldn't organize yourself out of a wet paper bag, even if you had a flamethrower, if you're not good at doing things on time, you're not good at paperwork, you're not good at details, you probably shouldn't be the custodian of your own 401k. You're probably going to screw it up, and we don't want to see that. But you have that option. You can borrow from a 401k personally. That's something you normally can't do from self-directed accounts. You're normally not able to borrow personally from those accounts. You can borrow up to $50,000 from a 401k. Now, I don't like to borrow from my 401k because I'm taking money. If I borrow from my 401k, I'm moving money from the tax-free world into the taxable world. I don't like that. That's not my optimal outcome. I like knowing that if I need a quick 50 grand, it's there. I like knowing that I essentially have an emergency line of credit, but I really don't want to use it. So those are the reasons I love 401ks. Let me talk about one other item, and we'll just open it up to Q&A. What do you need to qualify for a 401k? Especially a self-directed one. Because if you have a 401k, your W-2 job, your regular job, they don't let you self-direct, right? Their vision of self-direction is, which of our mutual funds would you like to buy? But you can't put it into real estate or lend it or whatnot. So how do you have your own self-directed 401k? You have to have a side business. It doesn't even have to be an entity. A side business that generates earned income. Earned income. What does that mean? What is earned income? Let me define what it is, and then let me define what it's not. Earned income is services income. For example, my law practice, I get paid to give advice. Or the sale of inventory. You sell the same thing over and over. It could be straws or cups or cars or real estate. That's earned income. What's not earned income? Rents, dividends, interest, royalties, and capital gains. Let me repeat that. Rents, interest, dividends, royalties, and capital gains are not earned income. So they don't qualify you to contribute to a 401k. If you've got a side business that generates earned income, you qualify to have a 401k through that business. So that's the basics. What did we cover? One creative example of what you can do with this, run a bunch of flips through it, make your Roth 401k huge, and only pay 21% tax, even though your personal tax rate's 37%. You can borrow money to leverage and expand these accounts. You can partner with people to leverage and expand these accounts. Now, there are rules, there are details. We have to watch out for prohibited transactions. I gave you a real simple example of one, but if you're going to do self-directed investing, you need to know prohibited transaction rules cold. You have to know those rules cold, especially if you're dealing with IRAs, HSAs, or CISAs, because if you make the smallest mistake with those rules, you destroy the account. There are lots of creative ways to grow these accounts. I see people invest in rentals. I see them do flips. I see them do lending. I know people who own cattle, gold, guns, farmland, you name it. I would not run assignments through one of these accounts unless someone else is doing it. If someone else is doing it and being paid to do it, then it's a possibility, although it would cause UBIT. But we see all sorts of investments, and I'm frankly amazed at how few people actually use these accounts. A lot of people talk about it, but I'm surprised at the number of it being so low, how many actually use these accounts. Now, as you can tell from my website name, iralawyer.com, that's what I do, right? We advise on this. Where your custodian stops, we start. So the custodian will help you set up the account. They'll help you contribute to the account, and they'll give you a basic sense of the rules. But if you look at the fine print, they're not responsible for anything they tell you. It's not their job to protect your account. It's not their job to keep you from committing a prohibited transaction. That's your job, and you need education and advice for it. That's where I come in. My other website tells you what else I do, realestatetaxlaw.com. Realestatetaxlaw.com. In other words, we also do a lot of regular planning, but that's not really the topic of today's call. Maybe we'll do another one where we talk about the new tax law, because the new tax law has a lot of great stuff for real estate investors. The 20% pass-through deduction, depreciation rules, where you can get this on a rental property, on a new rental property. And I don't mean new build. I mean just you bought the rental property in 2018. You can write off up to 15% of the property. So not really the topic of today's call, but I wanted to give you a sense of the other stuff we deal with. Here's what I want to do. I covered kind of what I wanted to cover, a real basic description, and I had to keep it basic to keep it within a half hour. Let's do some Q&A. Let's see what's on your mind, and if you would, ideally, you either type in your question or perhaps
you can raise your hand.
Yes, if you raise your hand, then Stacy can let you.
I'll unmute your mic, and then you can ask the question as well. So either way. And so real fast, I had a question. I mean, I love the idea of being able to do the C Corp and the Roth 401k. So can you manage? So if I had a self-directed 401k, can I manage my rehabs in that?
No. Oh my God, no. See. Okay. The key.
So how does that work?
Right. So a prohibited transaction, and I said, we didn't have time to really go through those, but a very common prohibited transaction is you're not allowed to provide a service to the account.
Okay.
And we don't know what a service is. Congress never defined it. So I'm paranoid about prohibited transactions, especially if we're not dealing in a 401k, because why am I paranoid? Because if you get into one, it blows up your account. So I would avoid anything that could be a service. So let me ask 3 questions. You've got a rental in your IRA. You decide to manage the rental. I don't want to pay a manager. I'm too cheap and they don't do a good job and I can do it myself, because that's typical landlord mentality. And I get it. But could managing a rental for your IRA be a service? Yeah.
Yes.
And if it is, you blew up your IRA. It's dead if they catch it. If you have a rehab and you hire the subcontractors and do the design work and buy the materials and bring them lunch, what do we call that? That's a general contractor. Could that be viewed as a service? Yeah, I'm sorry, but you got to hire that out. If you do that yourself in your accounts, you are penny wise, pound foolish. You're endangering massive tax savings by not wanting to follow the rules. And I see it all the time. I see it all the time. You want to roll the dice, it's your retirement, not mine. The last one is this. How about you set up an LLC? Your IRA owns 100% of an LLC, and you become the manager of the LLC, the so-called checkbook LLC. Could that be a service? I think it could be. I can't say for sure it isn't. I'm careful with checkbook LLCs. I prefer to have a crony, a friend, be paid to act as the manager. So watch out for providing services to these accounts. Now, I see a couple of questions here. Michelle asks what about Airbnb? Okay, Michelle, let me give you a description of how Airbnb works for tax purposes. If you rent properties out on average 7 days or less, that's your average rental period, that is not a rental. That is a hotel. And it is earned income, so it's taxed on Schedule C if you're doing it on your personal return, not Schedule E, and you pay Social Security tax. If you're doing Airbnbs inside your IRA, then that income is hotel income. So it's considered UBIT taxable. It's an ongoing trade or business. So you can do it, but it sounds like the kind of thing you might do through a C corporation owned by the IRA or the 401k, or even a mix. Sometimes we see the property owned by an LLC and the business, the Airbnb business run through a C corporation is pretty common, both outside of IRAs and inside IRAs. If you rent out and your average daily rental is 30 days or less, and you provide significant services, you make the bed, you clean the room, that sort of thing, then that's considered Airbnb, aka hotel income. It's not rental income. So that's your rough guide. Can you pay for private school in Mexico with a CISA? Probably. I haven't looked at it in that perspective. I'd have to go back and double check the statute. University, probably not. But private school, K through 12, probably yes. But I'd have to double check the statute. I never thought of it, so it's a good question. Lori asks, oh, go ahead.
You missed one up front, up on the top too, Candace. She had asked one about if your other business has employees, can you have a solo K? You can have a solo K, right?
No, if your business has employees, you don't qualify for a solo K. You can still have, like I have that problem. I have employees, so I use what's called a safe harbor self-directed 401k. Safe harbor self-directed 401k. It's a little bit more complicated than a solo K, but not horribly so. So think about a safe harbor plan if you've got employees. Now, some people say, oh, John, I'll fix that. Not a problem. I'll set up another LLC. It'll have the 401k, and I'm the only employee. Screw the rest of the employees. That's a problem. The IRS has rules against that. So if you've got employees and you think you can get around your employee problem by setting up another entity, that probably isn't going to work. The IRS has rules against it. But think about the safe harbor plan. I use it and I'm very happy with it. Still with me?
I'm here. Sorry. Yeah, I put it on mute.
Okay,
yeah,
just
so Lori Martin is the next one then.
Okay, cool. So let's see. I have a small 403B. That's a government plan account that I need to move. Which account is good to start with? Lori, if you have a business that qualifies for a 401k and you want to self-direct the 403B, I would roll the 403B to the 401k. If you don't have a small business that qualifies for a 401k, then I would move it to an IRA. And let's see, let me scroll up to see the other questions. They're starting to come in, which is good. Questions are good. Let me.
You want me to just read them to you, and that way you can just answer them and.
Yeah, we could do that, or you can just help me track. So we're on Michelle now. Can we furnish?
Yeah, the next one is
for all property management. Yeah. Michelle, here's a question. Okay, two issues. You've got an Airbnb and an IRA, and she's asking, can we furnish it? There are two problems. A, is that a service? Could it be a service? If it is, you're dead. Second, there's another rule that says you're not allowed to provide personal property. You're not allowed to provide property, basically, for the account. So you really should have someone else do everything. I really want you guys to understand that you're supposed to direct, not do, right? Direct, don't do. Aside from picking the investment and maybe writing checks, you guys should really be not doing anything. You should be purely directing. So I wouldn't furnish it. I would have someone else do it. Now, someone else can do it. It just can't be you.
All right. Mimi says, what situations must your IRA own an LLC?
Okay. There's no situation where your IRA must own an LLC. None. When should it own an LLC? That's a great question, because you got a lot of these idiots on the internet who sell checkbook LLCs. And because real estate investors are so cheap, they avoid getting good legal help, and they just go buy the cheapest checkbook LLC they can find. And oftentimes it's sold by a moron who has no idea what they're doing, which is great for me, because when you get audited, I make a ton of money. It's awesome. Appreciate that. When should you own an LLC? One, if asset protection is an issue. For example, if your IRA is into low-income rentals like mine is, you want asset protection from an LLC. The IRA, the 401k, doesn't provide asset protection. You want an LLC. B, if you need to have checks written on the spot, and I prefer that you have another manager who writes the checks. In some situations, I'll let the IRA owner write the checks. I don't like it, but in some situations, I'm okay with it. But let's say at an auction, the only way to bid is if you can write a check on the spot. There's no way the custodian can get you the money in time. Now, this is not an issue with a 401k, because with 401ks, you do have checkbook writing ability. So this is really just with IRAs, health savings accounts, and Coverdell's. If you need to write a check on the spot, an LLC might be useful. And the third situation where LLCs make sense for IRAs, if you have very high transaction volume and your custodian charges by the transaction. For example, I got clients who buy tax lien certificates, and let's say they buy, I don't know, 200 a year at 1,000 each, so 200 grand total. and the custodian charges $50 a transaction, that's a lot of money. I might set up a checkbook LLC to avoid those issues. I'd say those are the three situations when an LLC is appropriate for an IRA. If you're not in that situation, you're probably complicating your life and spending money that you don't need to spend on getting an LLC that you frankly don't need. And that's the other problem with the internet idiots. They're selling you something, so according to them, you always need an LLC. Well, when you hire a lawyer whose job it is to represent you in your best interest, I'm supposed to tell you when it's in your best interest, even if it's not in mine. In other words, I'd love to sell you the LLC. That's in my best interest. But your best interest may be that you don't need it. And I'm supposed to tell you that. And I, in fact, do so. I've talked people out of giving me money. People have come to me before with, hey, we've got money. We want to set up an LLC for our IRA. And I've actually talked them out of it because it wasn't a good thing for them. So let's see. I think Gerald's the next one.
Yeah, a 1099 independent contractor seeking to flip and flip hold. Can I have my existing C Corp established a 401 self-directed?
It depends what the C Corp does, right? In other words, the 1099 independent contractor business, that sounds like a service business, so it probably qualifies for a 401k. If you're looking to fix and flip, that gets a little bit complicated, right? Because the first few fix and flips, and there's no set number. Let's just make a number up for the sake of ease. Let's say the first 6 fix and flips you do are not considered dealer property. They're considered capital gains. Well, that's not earned income. So the good news is you don't pay Social Security tax on those first 6 deals. The bad news is they're not eligible for a 401k. But once you've got a pattern of fixing and flipping, you're a dealer, let's say the 7th deal, just to make up a number. At that point, that's earned income, and that business would qualify for a 401k. Now, I would note the entity doesn't matter, right? The key is, do you have earned income? So whether or not you have a C Corp or an S Corp or an LLC or none of the above, in terms of qualifying for a 401k is not really relevant. The question is, do you have earned income? And it sounds like the 1099 income probably is, and the fix and flip income maybe is. The buy and hold is not.
Okay. The next one's from Mohar. Can you have a solo 401k with no employees but all independent contractors?
Yeah, if you have no employees anywhere in your structure, not just that company, not just that entity, but anywhere in the structure, and they're truly independent contractors, right? It's not, I'll give you an example. If your secretary is in the United States, your secretary is not an independent contractor. You could say so, you could put it on paper, but if you look at the law, the IRS will classify anyone over whom you have sufficient amounts of control as an employee. Whether or not you say it's a contractor, they'll say it's an employee. So I caveat it by saying, if all you've got are independent contractors, and they really, honest to God, are independent contractors and not wink, wink, independent contractors, then yeah, you can qualify for a solo. Because what do you need to qualify for a solo 401k? The only employees in the company are working less than 1,000 hours a year, so very part-time. They work less than 1,000 hours a year. Your spouse, or in some situations, a business partner. In some situations, a business partner. If you have any employees other than those people, you probably need a safe harbor 401k. Now, what's nice about solo 401ks? They're super simple. They're super cheap and simple, even cheaper than a safe harbor plan.
So with the safe harbor, though, is that something that you can self-direct?
Oh, yeah.
Oh. Okay, cool.
Yep.
I'd never even heard of safe harbor 401k.
And what's the third kind of 401k that you want to avoid? You got solo, safe harbor, and normal. The problem with normal 401ks is they have to comply with a horribly complicated set of rules that you'll pay 10 grand a year for attorneys to deal with. So the safe harbor, the IRS makes you a deal. They say, we're going to cut the bureaucracy. We're going to make it a lot cheaper. But we need you to put 3% of every employee's salary into the 401k. So 3% of their salary or 4% of their salary, but only for the employees who actually contribute. And if you do the math, for most people with a few employees, it's way cheaper to contribute 3 to 4% to employees' 401ks of their salary than it is to have a $10,000 a year full-blown 401k plan.
Okay, all right, that's cool to know.
And now I'm lying down a little bit. I'm tired. Is this tell me this isn't the most laid-back tax attorney you've ever seen. Come on now.
What type of income qualifies for 6% in Puerto Rico? I'm expecting a large litigation settlement in 2 years.
Yeah, that won't work because the litigation is U.S. source. The first rule is it has to be Puerto Rican source income. Puerto Rican source income. And so there's a complicated set of rules that govern where is income sourced. For example, if you've got a rental in Atlanta, guess where it's sourced? Atlanta. What's allowing me to move to Puerto Rico? When I actually move there, my services that are performed in Puerto Rico, physically in Puerto Rico, are Puerto Rican services and taxed by Puerto Rico. What happens if I take a trip to Miami and I bill some hours for the day? That's U.S. income. I don't get the Puerto Rican break on that income. So this applies, for example, we see a lot of retirees doing this. They'll have mutual funds or interest income in Puerto Rico. All that income's exempt. Or they have a service business. We've seen crypto traders, day traders, radiologists, because they can work from a distance, right? A radiologist, you send them the images and they review them. Well, if he's sitting in Puerto Rico while he looks at the images, that's Puerto Rican income. So just to give you a sense of that, unfortunately, the litigation settlement would be sourced to the U.S., where presumably, I mean, I assume it's occurring in the U.S.
Okay, Ricky says, can I run real estate agent flip business through a C Corp owned by a Roth 401k and still be eligible for a 20% pass-through?
No. If you're running the business through the C Corp is not a pass-through. So the new pass-through deduction, which is the most friendly tax law ever written for small business, bar none, right? Pretty much the 20% pass-through deduction says if you run your business through anything but a C corporation or certain types of trusts, 20% of the income is not going to get taxed. So if you make $100,000 through a pass-through entity or no entity at all, anything but a C Corp and certain trusts, if you make the income, let's say it's $100,000 net, the IRS goes, it's only $80,000. It's only $80,000. They knock 20% off. But a C corporation, by definition, is not a pass-through.
What about, okay, Lori says, can I move my 401k to my LLC?
I need clarification on what that means.
Yeah, Rita, can you do that? Can you re-clarify? Ecta's next. Borrowing is allowed at either 50% of value or 50K for a solo 401k without tax penalties if it's done through the custodian, correct? And interest paid back to account?
Right. So Ecta got a little more precise on us. Ecta, are you an engineer or a software person? Because you're sounding like one. I can immediately, usually when I'm dealing with those guys, really detail-oriented people. So for the civilians, I gave a basic number. You can borrow 50 grand from your 401k. Ecta's number is more precise. You can borrow 50% of the value or 50,000, whichever is less. Also, there are certain rules in terms of the payback period, typically 5 years, and the interest rate has to be reasonable. So there are some various details I didn't want to mention on the call, but they're ones that Ecta brought up, so I'd say, hey, let's affirm. These are correct.
Okay, what about a father, son, and business together, no employees? Are we good for a solo 401k?
Nope. It's husband and wife or business partners, which if they're just business partners, it might work. Depends now on some details that are way past what you want to get into on this call. But if they're just business partners, it might work. Or if one of them works less than 1,000 hours a year. But if they're both full-time in a business and they're not a certain type of business partner, and I won't go into the details of that, then you'd have to have a safe harbor plan.
Okay. What are some reputable self-directed IRA companies you recommend?
There are a lot of good ones, really. I like Quest IRA in Houston, Kingdom Trust in Kentucky, Advanta in Clearwater.
Yeah. Or Advanta's here, so I mean, and actually, right. Advanta is a vendor of the South Atlanta area. So if you go to the main meeting,
they're easy to work with. I like UDirect over in the Bay Area. I like New Direction out of Denver. And I know I'm missing a few, and I feel bad because my memory for proper nouns isn't always awesome. But there are a lot of good self-directed companies out there. I'd say most of them are pretty good, with very few that are bad. And no, I won't tell you which ones I think are bad on the air while I'm being recorded. But thank you for asking.
We already know. Some of us do. Anyways, but okay, and then also, yeah, so and also Advana, what's really good about them is that they have Friday lunches. So if you want to go and talk to them on Fridays, they do like a free lunch and you can ask them questions and stuff. So you can just check out their website. Okay, also, have you read your KISS guides years ago? You're the man. How do we hire you? Oh, I have read your KISS guides.
Yeah, I sell various courses, and this was not meant to be a sales call. So I'll just tell you, I sell an IRA course that's not on the website. You'd have to shoot me an email. I sell a bookkeeping.
I was going to say, sorry, John, to interrupt. We do actually have all of your courses here. So I'm going to put them. Yeah, I'm going to put them on this. Hang on real fast. I'll put it on the chat so everybody can see it. So if you guys are interested, and then I don't know, did you get that link where you got to see everything that we have for you?
You know what? If you'd resend that, I've been so busy. I'm sure
you can click on it, but you have your bookkeeping home study course with Georgia entities, your new tax law recording, your workshop recording, and workbook. So we have like a whole bunch of stuff. Yeah. I think she sent us a lot of stuff. So. And
there is something you and I might talk about. I'm doing a live workshop in Atlanta, September 22nd and 23rd.
Oh, cool. Awesome. Is that with Dykes or is that just you by yourself?
Yeah, I talked him into being a guest speaker.
Okay, cool. Yeah.
Get even with me, because for those of you who've been to Dykes Bodiford seminars, which by the way, I think Dykes Bodiford is the man. He's one of the few real estate guru types for whom I have a great amount of respect. Both his knowledge and his integrity. I go to his classes a lot, and I sit in the back and heckle because we all have special talents, and that's one of mine. So he's going to get even and sit in my class and heckle. So we're going to have fun.
Cool. Yeah. Well, there is a link there. So if you kind of want to go over like some of the stuff that you're offering, and then if there's any last questions, make sure that you post them. Do you want to go over like what your
Yeah, let me do this. I'll hit these questions and then I'll hit what I've got.
Oh, actually, there was one more question that was missed. Why not options or assignments is what one person said. But I guess maybe we already.
That's a long discussion. I don't think I have time to go into it. If you look on my website for the Maffei case, there's a new case that came out, and I've been predicting this for years. Assignments and options in an IRA are BS transactions. And I mean that, and it sounds strong and harsh. It was meant to. It's BS transactions, right? An IRA is supposed to invest money. Oh, I invested $100 in my option and I made $10,000. It's not a real investment, and the IRS knows it. What you're really doing is running your brokering service through the IRA. And you want the proof that it's a service, that it's not truly a purchase and sale? Would you, for $100, give my IRA your assignment or your option? No. No, it's not what it's worth. You know it. So here's what happened. The Maffei case, Maffei, said that for an IRA transaction to be legitimate, you have to have skin in the game. And in that case, they said $500 is not skin in the game in the context of the amount of money they were making. Likewise, I'm pretty comfortable they would say $100 in an option, or an option, because a lot of the times you guys are hiding BS in your options. I'll talk about that in a second. $100 in an assignment or an option is not skin in the game. Second, the deal has to work with the IRS agent. In other words, if you're doing a deal with a financial friend, where you would never do this deal with someone else and neither would they. I'll give you a great example. I see this all the time. My IRA bought an option for $1,000 from my friend, and I made $20,000 on this option. It's a BS deal. Your friend isn't going to give you 20 grand unless you're cutting him a deal somewhere else. You're somehow cutting him a deal, right? If the IRS agent goes to your friend and says, I'll take an option for $1,000 that's going to make 20,000. In fact, I'll take 50 of those. Your friend's not going to do that. The only reason the deal works is because there's something going on behind the scenes. It's bogus. And my experience with most options, and there are some options that work, but the options that are these $100, $1,000 options that somehow produce $20,000, they're bogus, and the IRS is onto it. So sorry, I'm pretty aggressive. I'm pretty aggressive. When I tell you don't do something, you really shouldn't do it.
We got one question that says, I would like to take care of my adult daughters in business. Can I do something for them in a 401k?
What does that mean? Take care of adult daughters.
Gerald, you gotta explain. We don't understand.
Yeah.
Well, I have a couple of questions we didn't go into. So I have a 2-year-old daughter, and we want to put her into private school. So for the Coverdell, how does that work? Like to pay for that for her school, is that possible? Or?
It's hard, but not impossible. Here's the problem. For a 2-year-old daughter, the most you've put into that is $4,000. You can put in $2,000 per year per beneficiary. So the question is, what can you do with $4,000?
Yeah.
Not a whole lot on its own. Probably in this case, I would borrow and do a really sweet deal. I would cherry pick a sweet rehab if that's what you're into. If not, we have to discuss what are you into that generates that kind of money.
Mm-hmm.
I would borrow for a sweet rehab, and I would either use a C corporation to reduce the UBIT, or I would pay the UBIT, whichever is less. So you're not going to get all the money. Some of it's going to go to taxes, but what it's going to do is balloon the account and allow you to do more realistic things. So you take the hit up front, you borrow, you eat the corporate tax rate or the UBIT, whichever's less, because with debt it varies. We have to do some math. And once you have made enough that you're at critical mass, so let's just make up some numbers for a minute. Let's say you could do a flip for $100,000, just to pick an easy number. And you also need $10,000 a year for her education. The idea is with 1 or 2 deals to make about $160,000. Yeah. Pay the UBIT so that you got $110,000 left. Pay the $10,000 for her tuition, but now you've got $100,000 that maybe you can do 1 flip a year where you double your money, or you do 2 flips a year where you pull 50%, etc. So it depends on the nature and quality of deals you can get. But in a CISA, when you need to grow it that fast, you're probably going to eat some UBIT, and you really want to cherry pick the deals.
Okay, got it. And what about the HSA? Is it the same thing essentially? Because I have a high deductible savings account, but I just don't. I mean, for my health care, but I don't have a self-directed HSA. What should I do?
Do you have an HSA right now that's non-self-directed?
Yeah, that's not self-directed.
Yeah, you can roll.
I can roll that over?
Yeah, you can move it to a self-directed one. Here's what I do with my HSA. Excuse me. Here's what I do with my HSA. I contribute the max each year, which is just shy of $7,000, and I don't spend it. Because one of the nice things about an HSA is once the HSA exists, you're allowed to reimburse yourself in the future for any expenses you personally pay. Let me repeat and explain. Once the HSA exists, you're allowed to pay yourself for any expenses that exist from the day the HSA was born. You're allowed to reimburse in the future. For example, I set up an HSA tomorrow, Tuesday. I have a medical bill today I paid personally. The HSA can never reimburse me for that medical bill. I set the HSA up tomorrow, Tuesday. I get a medical bill Wednesday. I pay for it personally. As long as I don't deduct that payment on my 1040 on my personal return, I keep a receipt for the transaction. The HSA in the future can reimburse me. What does that mean? Initially, your HSA should take its money and invest and grow, and maybe take 10, 20 years to grow into something really big. Then 10 to 20 years down the road, or whenever, it starts reimbursing you for all those things you paid for over the years. That's why if you qualify for an HSA and you don't have one, you want to set it up tomorrow, because the sooner you set it up, the sooner you're allowed to pay for things personally that are eligible for reimbursement in the future. But similar concept in an HSA to the CISA, you probably borrow on the first deal. Here's what we did not have time to talk about. Once you have, let me think of this through. Decide what critical mass is in your account. I don't know what critical mass is for you. What's critical mass? How much money does it take to do a deal? 100,000, 200,000. Let's say it's 200,000 is your number, that if your CISA or your HSA had 200 grand, it could do a deal. Here's my strategy for growing these accounts. Borrow until you have 20% of critical mass, right? Borrow until you have 20% of critical mass. And that sucks because unless it's a 401k, you pay UBIT, but it's worth it. Bite the bullet. Then, instead of borrowing, get equity financing at low rates. Let me repeat that and explain it. Get equity financing at low rates. So instead of borrowing from a private lender at, say, 7%, I get a partner at 8%. I find a preferred partner who's willing to take an 8% return. So how do we do this? We set up an LLC. And by we, I mean me, because you guys will mess this up. Most of your lawyers will mess it up. They don't know how to do this. You set up an LLC that has Class A shares and Class B shares. Your IRA is Class B. Your investor is Class A. Class B puts in 20%. Your IRA has to put in 20% of the total money. Why? It's got to have skin in the game. Remember the rule from the Maffei case? The IRA has to have skin in the game or the tax court will disallow the transaction. So I would say Class B, your IRA puts in 20%, your investor puts 80%. What return do they get? Let's say 7%. 7% flat, not a percent of profit, but 7% flat. That's a preferred return. Google preferred dividend. It's the same thing. We got a guy that's investing capital instead of lending. He's getting a 7% return. Your IRA is keeping the rest. So it looks and acts like a loan where you put 20% down, but instead of a lender, he's a partner. Why does that matter? He's not a lender, he's a partner. Why does that matter? Because you don't pay UBIT. You don't pay UBIT on equity financing. So you get a partner that's cheap, maybe a 7%, 8% flat return on their money, and you avoid UBIT. But you got to have skin in the game. You got to have 20% of critical mass to invest. So what do I like to do? Borrow to get you to 20% of critical mass. Once you got 20% of critical mass, partner with somebody, a preferred partner who only gets a set return until you're at critical mass. Then the account can do deals on its own. That's powerful. When it comes to, again, the LLC agreement, you need someone who understands subchapter K of the Internal Revenue Code, the partnership provisions, and how to write allocation provisions in particular. And you need someone who understands IRAs. I do a lot of that work. If you get a hold of me at iralawyer.com, I do that kind of work.
Awesome. Okay, Gerald explained, he said make them an officer and have 401k.
Well, yeah, I mean, you can make your kids officers in the company. You don't even have to make them officers. You make them employees. Now, you got to pay them a real salary, meaning they have to do real work. No, John. I just want my kid to be an officer who does nothing, and I pay him a salary, and he gets a 401k. The problem with that would be the IRS would look at it and say it's a bogus salary. They didn't do anything. It's not real. So you can have kids hired by your company. They can have 401ks. You can pay them salaries to fund the 401ks, but they actually it's got to be a real salary. They got to do something.
Somebody asked how you spelled the Maffei case.
Maffei. If you Google IRA Maffei Hyre Hyre, the article will come up. In fact, I was in some newspaper for it. I guess I was the #1 Google on that because nobody understood the importance of that case. That case is hugely important for self-directed IRAs and especially investors who like to play the game with options, assignments, and other, my IRA had no money and now it has a ton of money types of games. The tax court's all over it.
Do you work with like mostly investors, or I mean, do you do like all different kinds? I mean, you're an IRA lawyer, but I mean like.
So that's one website, and the other one's realestatetaxlaw.com. So they kind of tell you what I do. They both feed to the same website right now. So if you do either one, they go to IRA Lawyer. but I do tax planning work for real estate investors across the country. We maximize depreciation. We convert ordinary gains to capital gains. We help them select and set up entities. We reduce self-employment tax. We maximize deductions. And of course, I also do a lot with IRA investors. And a lot of real estate people are into IRA investing, but I got plenty of IRA investors that they're not in the real estate. They do other things in their IRAs. So I would say real estate investors and IRA investors, that's 99.9% of my client base. They're all over the United States. As long as you're comfortable with virtual, right? A phone call and email. I do this kind of planning work everywhere. There are very few people like me. In fact, let me tell you a few things that make me unique. I litigate. So if you have an audit that goes bad and you want to go to tax court, here's the test of, do you have a decent case? If I'm willing to take your case on a contingency, you have a decent case. All the time I do this. When audits go bad, the key is get a hold of me within 90 days of the audit ending. You got 90 days from the end of the audit to go to tax court or you missed the boat. But we get 97% of the cases in tax court settle, and I don't have to travel to where you live because tax court's a circuit court. So they come to Columbus. I just have the cases tried here. They all settle before the trial, and we get really good settlements for clients. If I think you have a horrible case, I'll tell you. Usually the way I tell you that is, I'll do this by the hour. I won't do it on a contingency. And then you can decide which way to go. So we do fight the IRS. If you owe the IRS money, we let you know, and we're honest, because a lot of these 1-800 numbers are so dishonest. They lead you on with false hopes that they can drop your tax when a lot of the time they're lying. The IRS is a creditor, and what do? They look at your cash flow statement and your net worth statement, and they have a form for that. They don't trust you. They have a form, and they want you to back it up with documents. What's your net cash flow? What's your net worth? And if you've got enough to pay them, they're not negotiating. The only thing they'll negotiate is, when do you pay us? They'll do a payment plan. But if you've got enough to pay, they're not going to cut your tax. They're not going to negotiate. They're not going to horse trade. And if anyone tells you otherwise, they're a liar. When will the IRS negotiate? When you really can't pay. Let me tell you the best time to negotiate with the IRS: when you can't pay me. It's a great test. If you have a hard time paying the lawyer, you probably have a great case. So you got to borrow and pay the lawyer. If you can pay me with no problem, you probably can pay the IRS, and they probably will negotiate a payment plan, but they're not going to drop the tax. So we do a lot of that kind of work, but most of our work's planning work. Entities and structuring. We look at your bookkeeping. We look at your tax returns. How can you save money? Which deductions are you missing? And typically the way we do it is, I'll look at your things for 2 hours, and I'm not cheap. I'm worth every nickel. I am worth every nickel. I'm not cheap. I'm $400 an hour. I will take 2 hours typically to look at all your stuff, and then I'll give you a quote on planning, a straight somewhere between $3,000 and $15,000, based on what I think I can save you and how much stuff you've got for me to look at. Normally, I'll save you 10 to 40 times what I'm charging you. So I think it's a pretty good ratio. So we do that kind of work nationwide. I don't presently do tax returns. I used to. I don't anymore. Maybe I'll get back into it one day. Right now, I just don't want to. Why am I better? A couple reasons. I've been to tax court. For example, I'm the only lawyer you know who's been to tax court on self-directed IRAs at all. I've been there twice. I won both cases. And by won, I mean the IRS said the clients owed $150,000 and $500,000 each, and I got it down to zero. That was a victory. And we didn't even have to go to trial. I got them to concede before we went to trial. So it saved my clients a bunch of billable hours. I go to tax court a lot. I know how it works. Second, I fly to Washington, D.C. I go to the tax court. I pay 50 cents a page to pull not just the case law. Everybody can pull case law off the internet. I go to the tax court. I pull the cross-examination of the IRS asking the taxpayer questions. I pull the IRS lawyers' briefs. I pull the tax returns of the people who are getting drilled in court. I look at all that stuff. I go into great detail. I spend a lot of time on it, and I put a lot of money into it at 50 cents a page. But I know stuff most other lawyers don't. That's why I'm worth it. That's why I'm so good at what I do. Let's remember also, I invest. Just like you guys, I'm practical. I don't give you tax advice that makes no business sense. Let's see here.
We have got a couple more questions coming in. What do you do if you think you've committed a prohibited transaction in an HSA?
Okay, so let me tell you, as a lawyer, I can't tell you to break the law. If the prohibited transaction is black and white, you got to report it. Now, can I force you to do it? No. So if you call me and you show me a prohibited transaction and I say, wow, that's black and white, you lent your mother money out of your IRA, there's no gray there. My advice will be report it to the IRS. Now, whether or not you actually do so, well, that's on you, right? I'm not your accountant. I'm not signing your return. I don't have any liability for how you behave. Now, if it's gray, it could be prohibited, but maybe it's not, then I wouldn't report it. It's gray. So it depends on the nature of the prohibited transaction, of what you're supposed to do. And then you have a business decision to make. What do you actually do?
Okay, since you're savvy in accounting too, will you share an opinion on this? Getting conflicting info from attorneys and CPAs regarding disregarded LLC. Spouses can be members of a disregarded LLC when formed in only certain states, not all, correct. In other states, they could be defaulted into P-ships or partnerships for tax purposes.
Okay, here's the rule, and this will be the last question because my son's waiting for me to take him to dinner. If you're in a community property state, you can treat an LLC that is owned by spouses as a single member disregarded LLC, which is a lot simpler for your tax filing. If you are not in a community property state, then you are, so here's what the technical rule is, then I'll give you the sort of, here's how it works. The technical rule is, if you have two spouses in an LLC in a non-community property state, it's a partnership and you have to file a separate partnership return. However, as a practical matter, let's say you don't file a partnership return in an LLC that has spouses in a non-community property state. Instead, let's say it has rentals and you put them on Schedule E. As long as you file Schedule 10 or Form 1040 with the Schedule E on time and you report all the income that is supposed to be reported, the IRS will not penalize you for failing to have filed a 1065. So technical rule, spouses have to file a partnership return, a 1065. Practical rule, the IRS overlooks it as long as the income was reported on the 1040 in a timely manner.
Okay, so I listed all your packages again right here. So all his packages are here if y'all are interested. And also we did record this, so I'm going to stick it. Everybody knows that the member site is going to be open. So y'all should start getting emails on that. And then there is a webinar section on there, and we're going to stick it in there. So that's where you'll be able to see the replay, is if you are in the member site. So people were asking, is there a replay? Yes, it's in the member site under webinars, okay? Any other final questions for John before he goes off and has dinner? Anything else? All right, well, we appreciate it. So hopefully in 2019, we'll be able to have you come out and talk to everybody. I know everybody's going to love it, so.
Getting me to come to Atlanta is easy because I love visiting Bodiford. So as long as we coordinate it with me pestering him, I'm sure we can make it happen.
Okay, cool. And also he's doing a webinar, or not a webinar, a boot camp on September 22nd and 23rd, or that was what it was. So you can go to his website, I'm sure, to register for that. That doesn't do anything with South Atlanta area.
Cool. I appreciate the plug. That's kind of you.
Yes, of course. Okay, so I think I tried the link again. Click on that and make sure that works, y'all, so it works. So we can make sure, because somebody had said that it doesn't work. So I'm on the page, so it's got to work. All right, somebody click on it and make sure y'all can open it up. Does it work? Okay. All right, everybody's in. Cool.
Cool. Y'all take care.
Okay, I appreciate it. Thank you, John. All right, you guys, everybody have a good night, and I will see you at the next meeting. Bye.